Let's take a look at the bigger picture. Matthew Johnson's with us, president owner, Johnson Wealth and Income Management. Thank you for being here. So, look, we've had a tough run. I said, so goes October as August and September has gone. And while the bulk of selling historically happens during that August, September time, the bottom is usually hit in October. And look, we're down over 400 points on the Dow. What are you thinking here?
Well, thanks for having me back on again, Nicole. It's anybody's guess right now what the Federal Reserve is going to do. And I think that that's what's weighing on the market so much. We've reached this point with the Federal Reserve where their dialogue to us is very gray. It's very ambiguous. They're using terminology. They're using words where they're telling us we could raise interest rates, maybe we won't. You better be looking for higher interest rates for longer, but in the future we'll probably cut. We just don't know when. And what that really does is it wears on the mind of the average investor. Investors don't have a clear, specific direction as to where they're going to go. They're guessing, and one investor's guess is just about as good as the next investor's guess. My hunch is that we're going to continue to see more volatility, and it's going to be very choppy as people are trying to bet what's going to happen in the next 3 months of this year.
I mean, does the choppiness bring some opportunity?
Oh, 100%. One of the things, I'm a fixed income guy. My job as a fiduciary is to work with people that want income, right? And they don't want just income that is a cash flow. In other words, they don't want to create income by selling assets. They want the assets that they own creating the income. And when we look at what the Federal Reserve has done with interest rates, how the market has responded to that, I think that there's a couple of really critical things that we need to keep in mind. The first is, number one, they've given us a gift. When you think about equities, for instance, you know that equities have come down. We know that they could come down even further. But if we've got cash sitting on the sidelines, that's an opportunity for us to buy some really good quality companies. But more importantly than that, we need to get it out of our mind that, growing our money through appreciation is the only way to do it. I teach clients that growing their money needs to be part appreciation, but it also needs to be part dividends. And when you think about that dividend component, when you think about interest, and you can buy things like individual bonds, you can buy preferreds, you can buy good quality dividend paying equities. These dividends are awesome because we can use the dividends as an opportunity to buy more, which helps us during times of volatility like this. But let's not forget fixed income, because we have seen a sell-off in the bond market. We've got opportunities to buy contracts that are selling at a discount. And that means that not only do we get more interest income right now, but when these contracts mature down the road, that means that we're likely to have a capital gain. And who doesn't want that right now?
Right. And as you mentioned, fixed income and dividends, and those are sort of the go-tos, particularly in a tough environment like what we're seeing here. And as far as the equity markets, you've had the same names leading the whole year, right? When you think about the Magnificent Seven. When is the time to look at some of those names? Is it when the Fed is cutting rates next year, or is it now that many of them are down off 10%?
I really don't think that it's now. I'd like to see a little bit further into the future if possible, because here's the thing, I think many investors were thinking that by the middle of this year, Nicole, we would have had the Federal Reserve officially halt raising interest rates. But every time they raise interest rates, what it does is it kicks that can a little further down the road for them to consequently begin cutting interest rates. So I think it's still a little bit premature, because I think that there's too many moving parts right now. There's too much weighing on the mind of the average family, the average investor, the economy as a whole. So I guess my sentiment would be hold off, continue to remain patient, because I think that there's still a little bit more loss to be had before actually entering and taking a big position in some of those companies.
All right. And in the meantime, as you think about the Fed, do you think the Fed has done enough? Have they done their last rate hike? Even though you mentioned how it's providing this headwind, because people don't know what the Fed is going to do. And that's the sort of, the wild card or the scary part, because if they raise a lot, will it slow the economy and push us into the hard landing recession and such? What do you think the Fed will do?
Well, I think that the Federal Reserve right now is extremely scared of doing two things. Primarily, number one, they do not want anything that they say or do to be taken as dovishness, right? They don't want to have any real private interpretation of what they're saying. They just would prefer us to sit on the sidelines and just wait for them to act. But I think the bigger, scarier thing for them is they don't want to be repeating the 1970s where they've stopped raising interest rates too early and then consequently seeing a resurgence in inflation. That would be disastrous for them, right? Because they've already been considered kind of the whipping boy for not beginning to tackle this issue soon enough. So they don't want to have that reputation on the far end of things as well. As a result of that, I think that the Federal Reserve has gone far enough. I really honestly believe that. I think that they need to leave things alone. They need to let the economy naturally catch up to what they have done, because let's face it, they did 11 rate increases in pretty short succession. There's nothing that's ever been done quite like this. And so we need to let things catch up. We need to let the economy catch up to what they've done. And I think that if they do, they're going to leave a much broader opening for them to have that quote unquote soft landing that they tried to pitch us on in 2022.
Yeah. Matthew Johnson, great to see you. Johnson Wealth and Income Management. Thank you very much.